Yes, thanks, Mike. So this tweet comes from VBL's Ghost, and he's got 5 predictions up here that I thought were really interesting and our viewers would really like us to go through because some of them are plausible, some of them maybe not so much. So we'll go through each of the 5. So let me read the 5 and then we'll go through them. Number 1, the LBMA and London precious metals market will be exposed in a major corruption scandal. Okay. Number 2, the US government has been quietly accumulating gold since December 2024. Number 3, the United States is executing a new bilateral soft devaluation strategy, a decentralized version of the Plaza Accord. Number 4, the US will revalue its gold holdings to a higher price level to support fiscal objectives. And number 5, the US will hedge its gold to retire debt and stabilize trade relationships.
Something major is happening in the gold and silver markets, and the data coming out now is validating warnings that analysts like Mike Maloney have been sharing for years. Gold has surged nearly 59% in 2025, recently breaking above $4,380 an ounce and holding strong despite heavy attempts to suppress it in paper markets. Silver demand from solar, EVs, and advanced electronics is running at record highs, pushing the global market into its 5th straight annual deficit. Meanwhile, Western vaults are being drained at a speed we haven't seen in over a decade. London's gold stockpile hit its lowest level in 5 years after over $64 billion worth of gold was redirected into the U.S. to stabilize physical inventories. Silver inventories across major global exchanges have fallen by roughly 678 million ounces since 2021, nearly 10 months of mine supply removed from the system. And perhaps the biggest signal of all, physical gold in Asia is trading at a 5 to 7% premium over Western spot prices. That is real-world proof that the physical market is no longer aligned with the paper price. This divergence is exactly what Maloney has been pointing to, and the numbers now fully support it.
Does it mean hedge or?
It does not mean hedge. I think he means leverage. Like they'll use its gold to retire debt and stabilize trade relationships. So it's not hedging in a hedging sense. It's leveraging.
Okay, so LBMA, that's the first one, right?
Yeah. Are we going to get a major corruption scandal? Let's see. Well, we've seen for a long time that there certainly looks like there's price suppression. And I've got a couple of charts.
So there already is a major corruption scandal that's existed like almost forever. It's just that people don't know about it yet. But this actually should be major news.
Exactly. So this is decades old. I mean, you could say 50 years. 50 years they've been using the London markets to suppress the price of gold globally. And the data just supports that overwhelmingly.
So this is basically from the AM fix to the PM fix. When London trading is open, what that percentage price difference is connected to the previous day of the PM fix. So it ignores the data that happens overnight in London where the rest of the world is trading. So if the only market that existed for gold was London trading, the price would currently be $3.76 an ounce.
Exactly.
Insane.
It's unbelievable.
Did I explain that correctly?
Yeah, I think so. If people didn't get it, if gold only traded during London hours, and when the markets closed at night, if you pretended that overnight trading didn't happen at all, and when it opens up in the next morning, you just kind of paste the gold price back to back and keep going, you would see that it keeps going down and down and down and down and down, day after day after day, whenever the London market is open. And an ounce of gold would be $3 right now, not 4,000. $3.
Yeah, so the LBMA is nothing but a price suppression scheme, but it happens little tiny increments every single day, going down and down and down. Okay, let's move on.
Exactly. So the flip side of the coin is what's happening in the other markets. So when London is closed, so overnight, if you take all those gold prices and paste them back to back and look at the cumulative return, you'd see that the price of gold goes up and up and up and up, and it's just shy of $40,000 an ounce. So 10 times higher roughly than today's price.
So all of the percentage change of the hours where London is closed, London is not trading. And so you're taking the percentage change today, you're pasting it to yesterday of when London was not open. And Yeah, this is amazing. And this is evidence that is like 100% irrefutable. This is it. LBMA is nothing but a gold price suppression scheme.
Yeah.
The whole thing. Yeah, LBMA is a scheme spelled SCAM.
Yeah, scam. Exactly. Yeah. So big thanks to James Henry Anderson for providing these charts from Gold Charts R Us, Nick Laird.
Yeah, Nick Laird.
So amazing. So looking at those two together on the same chart, it kind of looks like this. So the first line is this black line, price going down a lot. The second line is this blue line going up super high. And then the actual price of gold that we're familiar with, that's this red line up, around 4,000 an ounce.
Wow.
So that's what it looks like. And it's a similar story with silver, by the way. Just looking at the same kind of lines, silver during London hours is down. It's a few cents, 23 cents. Silver would be 23 cents an ounce.
Wow.
So that's unbelievable. It'd be about almost $400 an ounce outside of London hours. And then, of course,
we're at that price where we say that it's going into triple digits. And I've been saying that for years. And this is proof that it should be there. And this is actually the reason for the structural deficit. When it doesn't pay to mine the stuff, you have not enough coming to market to fill demand. And that's what we've had for many years now in a row, a huge structural deficit.
Yeah. Exactly. And one thing people might say to kind of argue against this point, just broadly speaking, in terms of gold and silver, is that, well, there's a flow of metals from west to east. And so if there's selling pressure in the west and buying pressure in the east, that could cause the difference in price here. And that's true in a small way. There's no way it could be this extreme for 50 years. There's no way. So
exactly. And the other thing is that the LBMA is that blue line incorporates Comex trading hours, and the LBMA is only open. They're running like 5 hours earlier in the day, so there's only a couple hours overlap in that PM fix. So the Comex is also, it's a fractional reserve scheme. Whether it's a price suppression, well, it is a price suppression scheme. People from J.P. Morgan went to jail over it. For years, the Gold Antitrust Action Committee has been screaming foul, screaming that there is a manipulation going on, and they've been laughed at and called conspiracy theorists. And then somebody goes to jail for it, and people still call them conspiracy theorists. And then another person goes to jail for it. And so, what does it take to wake everybody up that this is price suppression? And it's happening in both gold and silver. And it's the LBMA that is one of the main culprits. And, if you look back over the last decade, you'll find that there are banks that pulled out of the price fix. The price fix is just a group of banks that decide gold and silver they look at market prices and they decide this is the fix. And then a lot of dealers are selling off of that fix all day long. And then at the close of the day, there's a PM fix. And this is the proof that they are the key culprits here.
Exactly. So getting back to our 5 predictions, will the London precious metals market be exposed? I mean, depending on your standard, they already have been. It's sort of hiding in plain sight.
Well,
who knows if it'll take another form.
They were running out of gold a while back, and then gold flows started happening from the United States. It's interesting if you look at since COVID, the way that world gold flows just suddenly like switch, like it's an emergency, and it was. The Comex was going to have a force majeure basically if they didn't get refilled, and a whole bunch of gold flowed out of England. And then the Swiss refineries all stopped shipping to anybody else on the planet and shipped only to the United States for a few months. We wrote about it in our book, The Great Gold and Silver Rush of the 21st Century. But then recently, the LBMA was running very, very low on silver. And all of these exchanges are just nothing but fractional reserve schemes. the number of contracts that exist, the ounces of paper, gold and silver, which sets the spot price, can be so many multiples of the actual physical that's there. And the LBMA became very dangerously low on silver. They became low on gold back during COVID, but they really became low on silver recently.
One of Mike Maloney's most important observations is that London trading hours consistently suppress gold and silver prices, while global markets outside London hours push them dramatically higher. And now we have the data to back it up. If you track gold only during London's AM to PM fix window, the cumulative downtrend would place gold at roughly $3 to $4 per ounce today. But if you track gold only during the hours when London is closed, the cumulative returns point toward a long-term trajectory that climbs toward $40,000 per ounce. This isn't random volatility. It reflects how a system based on heavy paper leverage, fractional reserve bullion, leased gold treated as real reserves, and concentrated pricing windows creates persistent downward pressure during London's trading hours. Silver shows the same distortion. London session behavior pushes the theoretical long-term price path toward 23 cents, while non-London sessions push it toward triple-digit levels. This aligns directly with Maloney's long-running explanation of how the paper markets conceal gold and silver's true value. These distortions become even more dramatic when compared with today's real-world fundamentals. Industrial demand for silver reached 680 million ounces in 2024, the highest ever recorded, and is climbing again in 2025 due to explosive growth in solar power, electric vehicles, and next-generation electronics. This massive industrial appetite is colliding with a global supply deficit that has persisted every year since 2021. The 2024 deficit alone was nearly 150 million ounces, and 2025 is expected to bring another shortfall in the range of 117 to 149 million ounces. At the same time, major vaults across the Western world continue to be drained. London gold holdings have dropped to a 5-year low, registered Comex gold is hovering near decade lows, and combined silver inventories across London, Comex, and Shanghai have fallen by around 678 million ounces since 2021. According to analysts, this is one of the most significant physical drawdowns of the modern era, a trend that mirrors Maloney's long-standing warning that the paper system would eventually struggle to meet physical demand. Central banks are reinforcing this trend by adding gold at some of the fastest rates ever seen. Many emerging economies are diversifying their reserves, and multiple analysts now estimate that China's true gold holdings may be twice the officially reported figure. This steady accumulation further tightens the physical market. Meanwhile, the financial environment is pushing even more investors toward precious metals. Banks in the United States are carrying more than $650 billion in unrealized losses on government bonds, and concerns about long-term debt sustainability continue to rise. This has amplified gold's role as a hedge against financial instability, another point Maloney has emphasized for years. Taken together, the price suppression during London hours, the relentless physical drawdown, the multi-year silver deficit, central bank accumulation, and financial system stress all reflect the exact conditions Maloney has been preparing investors for. The physical market is slowly overwhelming the paper market, and the data shows that we are approaching a major tipping point.
So anyway, let's move on.
Exactly. So that leads us into number 2. The U.S. government has been quietly accumulating gold since December 2024. Not so much of a prediction if it's going backwards, but that's okay. So has the U.S. been quietly accumulating gold since December? Well, if we look at U.S. gold imports and exports with the world, we can see that this big spike here that's kind of unprecedented, that happened in December of 2024. And you can see a few bars here around that area. And net imports, if you subtract out the exports, we do have massive net imports into the United States. So it certainly could be the case that the U.S. is hoarding gold.
I also have done longer term charts of this going back a lot further. And if you go back before COVID isn't in here, and it's a shame because there were also enormous bars, the red bars going up. And then you look before that, and there's almost never a month where we are a net importer. It's almost always exports. So this is after COVID, but before COVID, it's just almost never. the U.S. mines gold, and then we've got to ship it somewhere to get refined. And a lot of those refineries are the Swiss gold refineries. And so it is typically net exports. So this is highly unusual. Now, this was when Donald Trump was threatening to audit Fort Knox. This was during a rush, and I believe Comex stocks were getting low again, because the Comex is another fractional reserve scheme. 300 people dancing around the room and only one chair to sit in, the actual ounce of gold that exists on the exchange for delivery. And so they've changed those ratios. And whenever they're doing this, they're getting ready for something that might happen. So they're getting ready for a potential event. I want to point out that this chart is from July. So it'll be interesting to see what happens over the coming few months here. So,
yeah, exactly. We'll have to keep following this.
Yeah, so there was some gold inflows into the United States in July. So show us that next chart.
Yeah, the next one is the Comex Depository Warehouse gold stocks. So basically, this is a chart we put in the book, Mike. This is in chapter 9, which was called "Somebody Big is Getting Ready for Something Really Big."
Yeah. Now this goes back a lot further. And yeah. Okay. So they basically saved the Comex from a force majeure, and they stopped gold from like just leaping to $5,000, $6,000, $10,000 an ounce by having all these gold inflows from the Swiss refineries and from London and even from China, which had never happened before. So it's like the whole world was coming to the rescue of the Comex to keep the fraud of their fractional reserve scheme from being exposed, which would have caused gold to just suddenly leap into the stratosphere. And what was gold's price back in 2019 and early 2020? Was it still below 2,000?
Yeah, you can see. Oh. Yeah, right here. This is the 2,000 line. So it just peaked above 2,000 barely.
Well, that's with those big inflows. But before the inflows happened, we were down at 1,700, 1,500. Yeah, amazing.
Yep. And so you're right. There was a force majeure that was prevented with all this gold. And now we have another spike similar to the COVID spike where we're up at higher levels. So
they're getting ready for something.
Exactly.
Some big event. Right. Okay.
Exactly. So getting back to our prediction, is the U.S. government quietly accumulating gold? I mean, what we just looked at, it's not government gold, right? But we're seeing gold flow into the United States, which is unusual. That's kind of the point.
Right.
So
now, you could, and maybe we should do this for a future video, if we get the raw data from Nick Laird of those gold flows and then deduct what actually went onto the Comex. Any excess that did not end up in Comex vaults could have been accumulated by the government. So it'd be very interesting to create that.
It would be. And just for anyone curious, if you look at any of the official numbers for gold holdings by the New York Fed or Fort Knox or just any of these places, they haven't changed. They're all flat. And so part of the prediction here is that it's happening secretly. Maybe they're replenishing old amounts that aren't there. So it's very hard to get data about those exact numbers, but it's possible that this is happening.
And all of the gold that the U.S. does have has been pledged to the Federal Reserve and is used to back Federal Reserve notes at $42.22222 on into infinity. 42 2/9 dollars. Central banks lease gold, period. This is a fact. And if that gold is all leased and they want to do something with it, they would have to unwind a bunch of those leases. And if they unwind those leases, it causes the price to rise. So this is could be part of what is driving the price. But
exactly.
So is the government accumulating gold? It wouldn't surprise me because China has been doing it secretly. They report a certain amount, but it is suspected that the actual amount is more than double what they're reporting.
If there's one takeaway from today's numbers, it's that the physical market is quietly overpowering the paper market. Gold is making record highs. Silver is in the tightest supply environment in years. Vaults continue to drain. Central banks are accumulating. And physical premiums overseas are rising, a clear sign that real-world buyers no longer trust Western paper pricing. This is exactly the scenario Mike Maloney has been describing, where suppressed prices collide with undeniable physical scarcity. Now I want to hear from you. Do you think gold is heading beyond $5,000? Will silver finally make the breakout toward triple digits? And which cracks first, the LBMA or the Comex? Drop your thoughts in the comments. I read every one. If this breakdown helped you understand what's really happening behind the scenes, hit like, tap subscribe, and turn on notifications so you never miss a major update. Because paper prices can create illusions, but the physical market never lies.